All right, well, let's move on to something that you can't keep around, and that's groceries. You do have to consume those, or else they go bad. Although I'm also known for like, well, who cares about the expiration? It still tastes fine. Who cares? It's December 31st. It's like it's March. It still smells fine. That's my grandmother. It smells fine. You can eat it. Let's talk about Kroger. Yeah. Oh, Priscilla's got to look like, what? You eat that? I'm like, yeah, it tastes fine. My wife is the same way. Let's move on here. Talk about grocery stores. Talk about Kroger. They are in the grocery store industry. I'm sure you know the store. Float on the short side is 5.5%. Not worrisome at that number. We do see a PE ratio that is kind of worrisome. It's pretty high, 55.8 versus 25.6. Price of sales 0.3 versus 0.4. Price to book value 5.8 versus 2.8. And price of cash flow 7 versus 7.1. They do have a PEG ratio of 1.8. That is far better than the industry at 13.4. So valuation ratio is not really great here. We do see the earnings over the past year for Kroger up 4.2%. Sales are actually down 1.9%. I think they had some. Did they acquire somebody, or they got acquired, or something? Something's going on with Kroger.
I think they were buying Albertsons.
Yeah, I think they. I don't know.
I think it didn't go through, though.
It didn't go through. That's what I was thinking as well. They do pay a decent dividend, and this is probably a company that you hold that you're not going to make quick moves on it, but it's kind of could be a good long-term buy if you buy at the right price. But they do pay a 2.2% dividend. Only use 32% of their earnings to pay that out, so that dividend is pretty safe there. Taking a look at the balance sheet, current ratio 1 versus industry at 1 as well. But debt to equity could be a problem here, 2.7 versus 1.9. Again, I will check that balance sheet, see if I see anything there. Net profit margin 1.9, same as the industry. Return on equity is 29.2 versus 16.3. And this is why return on equity is so important, because it's the profit margins on grocery stores is very slim, but you have a lot of turnover. That's why you look at return on equity, because that kind of takes that into account. So very good return on equity, 29.2. Free cash flow, very good, $2.2 billion, about the same as the industry. What do you got going forward, Chase?
Yeah, well, looking at Kroger here, their current price is $63.19. 52-week range, the low here is $58.12, and the high $74.90. Looking forward for the business, I mean, the valuations, they look, I'm going to say, pretty decent. You go out to January 2027, you see estimated earnings per share of $5.29. Gives you a target sell price of $87.81. Trades under 12 times those future earnings. And the thing that's interesting is earnings growth is pretty strong. I mean, you look at 2026 for the fiscal year, you're looking for about 7.5% earnings growth. 2027, analysts are looking for over 10% earnings growth. So I'm pretty surprised to see that level of growth for the business.
Yeah, and this is a company that you would be looking at investing in, not to, again, like have a quick hit on and so forth. This is a company that we would probably like for the right price, that you can hold for years to come, get maybe a 12, 15% on average return each year, year in and year out. That's what we kind of look at. I'm taking a look at the balance sheet here. They do have a fair amount of cash on the balance sheet, about $6 billion. Their assets are about $54 billion. Let me look. I bet you they have a lot of debt. Yeah, they got about $24 billion in debt is what they have, and that is actually up from about 3 years ago when it was $18.8 billion. So, and I think they did acquire somebody else years ago. And I think you're right. They tried Albertsons, couldn't do it for some reason. So the liabilities are about $44 billion. Their shareholder equity, or their stockholder equity, is about $9.2 billion. That's about the same it was 3 years ago. So it's not an exciting company. And this
what was their debt to equity?
Their debt to equity was, I think, a 1.9. I think is what I saw.
Okay, yes, that's a little bit higher than I'd like to see. Yeah. I mean, because the ones that I don't really know
2.7. I'm sorry, 2.7. Even higher than I like.
Yeah, because I was gonna say, I mean, I don't really recognize Kroger. We don't really have Krogers out here in California. And
isn't there one on Poway Road? I thought there was by the
maybe. It doesn't really pop up in my mind. But they also have Ralph's, which is more common in my mind here, and then they also have Food for Less as well. But the other thing that they have that I find interesting. They also have Fry's is another one that was more from Arizona. But the other thing I was reading today, it was kind of funny. The article was called "The Appetizer Economy."
The appetizer economy.
And the concept behind the article was more for eating out. All right. But when people are going out to restaurants, they're ordering more appetizers and kind of less entrees. So you go out with 2 people, instead of getting 2 entrees, you get an appetizer and an entree and split it to save money.
Yeah.
But also within that article, they really talked about how the private brands have been growing substantially as well. I forget, gosh, I want to say in like Albertsons or one of the stores, the private brands were going to occupy like a third of shelf space, which was a huge increase to what we've seen. Kroger has their own private brand. So I'd be very curious how the private brands in and of itself help a business like Kroger. You got to imagine that's beneficial to their bottom line.
Yeah, and they probably do get I'll say a better profit margin. But I've often wondered who makes those private brands. Many times it's a company that but they make private brands, which they don't make as much profit off of, but they still do it. I mean, you've got to be a food company to produce that. You can't just,
Yeah, like Kroger can't just use their grocery stores to make food, right? Like they have to have a food distributor. So, I don't know. But the big question is private label more profitable to them than selling like a Kraft Heinz bottle of ketchup? Even though it's cheaper for the consumer, is it more profitable for a Kroger? And could that trend benefit this business?
I think it is, and people can argue with me on this, but I try the private brand sometimes. I just don't think they're as good as the brand names. I mean, I like to eat raw vegetables with ranch dressing. I've tried, I think it's called Select from Albertson. It's like thinner. It's not as tasty as, and if I get it from, I don't know if ConAgra makes it, but the
Hidden Valley or whatever.
Hidden Valley, yes. Yeah. It's a brand name. It tastes so much better, and I think with the off-brand names or the non-brand names, I just think they pull a little bit out of it to save profits, but it doesn't taste as good.
Yeah, I mean, I'm not sure, but people are buying them. So, but if the economy improves, and again, the whole concept of the K-shaped economy, where the higher end's doing fine, the lower end's not, if things improve for the lower end and they start shifting away from the private brands, well, then that could be again a problem for a Kroger.
And again, and I'm older. You talk about an average family. You've got 3.2 kids. You're working. You're trying to feed these. your family. You know what? We got to take the lower brand. We got to save on groceries because it's going to be very expensive. So, that's why.
What do you do with 0.2 of a kid?
I just pulled it out to make it sound good. That 0.2 of the kid doesn't eat very much. but no, it's just something I look at that what's so great about our economy is that it fits for everybody. And this is when it comes to investing. You have to understand what's going to happen with it. You got to understand the business. You have to understand, you can't ever judge yourself saying, well, this is what I get. But, I made that mistake years ago when I said with Apple.
I don't have a smartphone. Why would I buy Apple? Yeah.
No, it was actually the iPod. When the iPod.
Oh.
I was going to do that. But I like my Walkman, so I missed that boat.
Yeah. But, I mean, we did make money off Apple, though.
Oh, we did. Yeah. I mean, we made good money off of Apple and some of the other companies. We're very cautious, so we do get out before it gets too crazy is what we do.
Yeah.
So, but
and I think you're right. I kind of made that mistake actually with a food company. I'm like, because my wife, we eat a lot of like just beef.
Yep.
Kind of like the raw food, so to speak, everything that is like not processed. And, we kind of talked a lot about it. We actually ended up buying a food company in the portfolio this year. And, just my preferences aren't the nation's preferences.
Right.
So you can't make that judgment call for other people, essentially.
Exactly. And you got to look at the nation as a whole. Where are people like in the South and the Northeast? And, and I still believe back East, I think there's a lot of people back East that still smoke, which is kind of amazing to me.
Yeah, the Altria and Philip Morris, it just blows me away how that stock still continues to do well.
Yeah. That's why you got to do your research. You can't just base it on your own opinion there. So,